Understanding economics, a path to becoming a better investor. The question of whether understanding economics can enhance one's investment skills is surprisingly contentious. Some argue that studying economic principles does not necessarily improve investment outcomes and may even hinder them. However, in today's highly financialized economy, particularly under a late-stage fiat system, having at least a foundational grasp of economics is not just beneficial, it is essential to safeguard your investment portfolio in the long term. Historical context. The gold standard. Let's step back in time to Sunday, August 15, 1971. President Nixon made a historic announcement on national television. "I have directed the Secretary of the Treasury to take the action necessary to defend the dollar against the speculator. I have directed Secretary Connolly to suspend temporarily the convertibility of the dollar into gold or other reserve assets except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States." Among those watching was Ray Dalio, now a legendary billionaire investor and founder of the hedge fund Bridgewater. At the time, he was a young clerk on the New York Stock Exchange, fresh out of college, thinking, "Man, this is bad." He was correct, although not for the reasons he initially believed. Ray Dalio's investment journey. Dalio reasoned, money derives its value from being a claim on gold. If that claim is no longer valid, money loses its value, and everything will collapse. Yet, he was in for a surprise. On Monday, the Dow Jones opened 4% higher. Investing in the stock market post-suspension of the gold standard would have resulted in a 22% gain over the next 18 months. This pivotal moment sparked Dalio's journey into understanding market mechanics, leading to further revelations and eventual stumbles. The 1982 market misjudgment. In 1982, the stock market had been volatile and declining for 2 years. Dalio predicted a recession or even a depression, given the Federal Reserve's decade-long battle against uncontrollable inflation, which saw interest rates reach a high of 19%. However, his prediction was off the mark. The stock market did not crash, but instead experienced one of the most significant growth periods in U.S. history, achieving a 225% gain over the next 5 years before the 1987 Black Monday crash. This experience drove Dalio to deepen his understanding of history and economics, leading to the growth of Bridgewater into the world's largest hedge fund and the publication of his best-selling books, such as Navigating Big Debt Crises. The long-term debt cycle. The early 1980s marked the transition to a new phase in the long-term debt cycle. Betting on a recession and stock market crash during this period was akin to predicting falling interest rates in 2021. Historical data from 1940 to 1980 shows that the U.S. government deleveraged, reducing debt relative to the economy's size from around 120% to 33%. This period of inflationary deleveraging often involved central banking practices like yield curve control. The decoupling from gold in 1971 further fueled monetary expansion. The shift in the debt cycle. During inflationary periods, long-term bond investors suffer due to returns not outpacing inflation, while short-term bond investors maintain liquidity. Active investing, especially value investing based on fundamentals, thrives. The shift to the next phase around 1980 brought disinflation and declining interest rates, culminating in a federal funds rate near 0% by 2020. However, assuming the near future will mirror the recent past is a common mistake. Understanding the long-term debt cycle is crucial for forecasting economic trends. Understanding the future. To anticipate future economic conditions, one must grasp the impact of the long-term debt cycle. Many in 2020 expected interest rates to revert to zero, failing to recognize a new phase of the debt cycle. From 1980 to 2020, the government leveraged up, aided by declining interest rates and economic growth, which allowed for increased debt affordability. However, reaching a debt-to-GDP ratio of around 120% forces a choice between austerity or inflationary deleveraging. Governments typically choose the latter. The current phase of the debt cycle. While historical patterns suggest phases last around 40 years, the fundamentals driving the economy, such as interest rates, leverage, inflation rates, and policymaker decisions, are more critical. Expect higher interest rates to combat persistent inflation, more money printing to fund government needs, and rising inflation and interest rates, contrasting with the previous 40 years of declining rates. Passive investing in long-term bonds will give way to active investing, short-term bonds, precious metals, and commodities. Watching liquidity. Beyond the debt cycle, liquidity is paramount. The money supply, particularly M2, reflects available funds for spending. Significant increases in the money supply, such as in 2020, lead to inflation and asset price surges. The money supply's contraction from April 2022 to April 2023 coincided with the S&P 500's bear market. Historically, money supply contractions follow expansions, often leading to deflationary spirals. Central planning and the money supply. Central planners, wary of deflationary pain, have leaned towards inflation since the Great Depression. The U.S. money supply hadn't contracted since 1949 until recently. A contracting money supply typically signals economic trouble, but the Federal Reserve's interventions have kept the stock market and assets like Bitcoin and gold buoyant. Liquidity drives markets, and understanding its flow is crucial for investment decisions. Conclusion. Comprehending the long-term debt cycle and monitoring liquidity changes are vital for making informed investment choices. The phrase "follow the money" takes on a new meaning in this context. Subscribe to our channel, All Things Money, to learn more about market mechanics and improve your investment strategies. Thank you for watching, and have a great day.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.